In apartment investing, effective exit planning includes developing contingency plans and risk mitigation strategies to address unexpected challenges. By proactively identifying potential risks, such as market downturns, financing issues, or regulatory changes, investors can prepare alternative exit strategies to adapt to changing conditions. This preparation ensures that investors can navigate unforeseen obstacles while protecting investment value and maximizing returns. Adapting to market volatility. Markets can shift rapidly, impacting property values and demand. Having a contingency plan enables investors to respond strategically to market changes, rather than delaying decisions or selling at a loss. Managing financial and operational risks. Financing challenges, regulatory changes, or unforeseen repairs can disrupt exit plans. A well-developed contingency plan reduces exposure to these risks. Maximizing flexibility. Contingency planning ensures investors can pivot to alternative strategies such as refinancing or holding to avoid loss or improve timing. Market downturns. A sudden economic downturn or decline in the local real estate market can reduce property value and demand, making it harder to sell or refinance. Financing challenges. Changes in interest rates or lender requirements can complicate refinancing or buyer financing, impacting deal feasibility and timing. Regulatory changes. New regulations such as changes in rent control or zoning laws may affect property value or limit potential buyers. Property condition. Unexpected repairs, maintenance issues, or code compliance requirements may arise during the sale, potentially delaying the exit or reducing proceeds. Buyer demand. Fluctuating demand can affect the pool of interested buyers, potentially resulting in longer holding periods or lower offers. Backup exit strategies. Prepare alternative strategies such as holding the property longer, refinancing, converting to a different property type, for example, condos, or executing a 131 exchange if a sale is unfeasible. Flexible financing solutions. Consider pre-approvals or lines of credit for refinancing options, ensuring flexibility if selling is not immediately viable. Market timing adjustments. Monitor market indicators closely and plan for possible timing adjustments based on observed trends. For example, if prices peak earlier than expected, exit sooner. If values decline, consider holding. Insurance and legal protections. Obtain insurance and review legal agreements to protect against potential liability during the sale or transfer process. Example: if an investor plans to sell but a market downturn reduces buyer interest, they can pivot to refinancing or consider a temporary rental strategy to maintain cash flow until market conditions improve.